Well, welcome to the Three Corners Capital Investment webinar. Today we're featuring Patrick Dillon with Community Capital Management, who's a leader in impact investing through bonds. Patrick is a client portfolio manager, and prior to CCM, he spent time at firms like Invesco, Zacks Investment Management. He is also an alumnus of Indiana University, and as I joked with him before we started the call, he's finally excited to have a football team, and their coach is doing a great job. But aside from talking football, and we have two overarching goals for this webinar. One is to talk about the fixed income landscape with bonds, and how managers can dive deep into the issues that they purchase in their portfolios. Additionally, we have more and more clients that are interested in learning about how their investments align with their values, and community capital management's approach to fixed income investing and impact is unique, and we wanted to highlight that approach here today. So with that, Patrick, I'll let you go ahead and kick us off.
Awesome. Thanks, Chris. Yeah, no, it's been an exciting time to be an Indiana Hoosier football fan for sure. It's been decades and decades and decades. So we're happy with where things are. But it's not about the Indiana Hoosiers today. It's about Three Corners Capital and Community Capital Management. Chris, thanks for the introduction. For those on watching this webinar who are not familiar with Community Capital Management, we got started back in 1999, managing impact bond portfolios for banks of all shapes and all sizes all across the country. And those banks were specifically investing in our community impact bond mutual fund, where we were vetting the fixed income securities for social and environmental impact under the guise of the Community Reinvestment Act of 1977. So our initial clients and investors in the late 90s and early 2000s were banks all across the country who were mandated to invest in what's called CRA, or AKA the Community Reinvestment Act, CRA eligible investments. What happened was we had a foundation come to us who basically said, hey, CCM, our foundation's mission is XYZ. We like what you're doing for banks. Could you guys manage a separate account that would align a bond portfolio with our mission for our foundation? And we said, absolutely. So we grew and grew and grew in the institutional space, and finally launched the intermediary share class of our mutual fund in 2007. Fast forward to today, we manage about $6.8 billion under management, managing a couple registered mutual funds and ETFs, as well as some separate accounts for institutional investors. So for us, impact means a lot of things, and it's all about aligning one's value set with their beliefs and their investments. We do believe that the ability to invest across different varieties of impact, whether it be a theme like affordable housing, human empowerment, gender lens investing, sustainable communities, we have done that for 25 years. And a lot of our investors and client base range anywhere from faith-based investors to sustainable investors to family offices, and just kind of retail clients who are looking to align their faith or their values with their part of their bond portfolio. So we're based in Fort Lauderdale, Florida. We got 40 people at the company. I live in the northern suburbs of Chicago and serve folks like Chris and Steve. So that's who we are, and that's what we've been doing, and we haven't changed our stripes for 25 years.
That's great. That's great, Patrick. So wanted to start off with a question about the bond market in general. Bond investors have been, through quite a ride the past several years, with rates being super low before 2022 and, having been normalized since then, and really, pretty nice returns over the past few years. But since the beginning of the year, we've seen inflation, ticking up some, more than the Fed would like. But yet they cut for the first time in a while last month, and the meeting today and tomorrow. So the market's still expecting more cuts this year and next. Just wanted to see what your thoughts are on the whole situation currently.
Yeah, great question, Steve. The fixed income market has been challenging for the last 5 years. Let's just call a spade, right? It's not been easy. When When rates go up, prices go down. And in the summer, coming out of the summer of 2021, rates went up, and they went up really fast, and they went up really high, and that hurts the value of your bond price, which effectively, has an impact negatively on the total return of your fixed income investment. So 2021 and 2022 were challenging years for fixed income investors in the public fixed income markets. We do believe in the intermediate high quality portion of a portfolio. That's where kind of the space that we play in. Going into and to more directly answer your question, Steve, going into this year, right? So going into January 2025, our team had expectations of a 10-year Treasury rate range bound between about 4 to 4.75%. And admittedly, that's kind of where it's landed, throughout the entire year this year. We did break through the 4% mark in the last few weeks, so that's noticeable. Our belief is that a lot of the rate decisions is kind of driven by the consumer, right? The health of the economy, right? We've kind of been in this K-shaped economy for the better part of the last few years, and with inflation, a TV can cost not too much, but your cost at the grocery, bill is still really, really high. So it's kind of this give and take. It's this ho-hum economy where we're still trying to figure it out. For us, the initial impact in 2021 and 2022 on bond prices was noticeable. But what we always like to say at CCM is that starting yields matter. So for the last maybe 2 to 3 years, we've actually been able to purchase much higher yielding fixed income securities in the public markets that eventually over time you kind of capture. And regardless of whether your views are that rates should go up because inflation is still kind of staying up, or maybe the economy is a lot softer than when we all realize that the data is not really showing anything, and so that therefore you would consider rate cuts to continue, which would be additive to a bond portfolio. We do believe that we have a lot of higher yielding securities on the books, which should be beneficial if we do continue to see rate cuts. So we watch a lot of consumer data closely. We continue to see a headline. It's almost like every hour, every day, where a company is laying off, XYZ number of employees, and we feel comfortable with where we're at and where we're positioned. As I mentioned, we're the intermediate, super, super high quality credit public fixed income manager, of which there's thousands out there, but we just do it differently on the impact side. And we've kind of shown through 25 years of investing that we've typically been a ballast in the portfolio when a lot of volatility has entered the markets, and maybe you're seeing stocks go down in your portfolio or something like that. So it's something that we're monitoring closely. One other final thought I would say on that is, we've already gotten one rate cut. We're going to see what happens today. We might get another one in the next couple months. That will certainly affect cash or money market securities in clients' portfolios, meaning the yield on your money market fund is probably going to continue to go down. And in that sense, that might be an opportunity where maybe not take all your money market or cash, invested, but maybe a portion of that cash could be moved into a very high quality fixed income portfolio, where you could maybe capture a little bit of that, again, rates down, price up, part of your fixed income portfolio, and get a little bit higher total return from a price and yielding and income perspective.
Right. Yeah. There's been a lot of concern about kind of the lesser quality parts of the bond market, and the fact that the prices for those bonds have been going up dramatically, and what's caused spreads, in bond lingo, the credit spreads have been really tight, and that's kind of based on, hey, the consumer's been doing great, by and large in aggregate, and so it's really good to have to be in the high quality part of the bond market in times like this, is what I'll say.
Yeah. No, I appreciate the thought on spreads. That's something our team watches very, very closely, right? I think we had a meeting yesterday. I think credit spreads are about 78 basis points over, investment grade or high yield, which, to your point, historically speaking, you zoom out on a credit spread chart, and it's extremely, extremely tight. And so what that means for investors is where do you go to see the potential kind of value, right? That you typically kind of look for. Going into this year, we actually saw a lot of value in the mortgage-backed securities subsector of fixed income, which admittedly is kind of where we're experts and where we have been for a long time. But again, the credit spreads are tight, right? And so in a more normalized environment, typically things can go one of three ways. You can go wider in spreads, meaning things get volatile. You can kind of stay the same, or spreads can kind of get lower. And that part of spreads getting tighter and lower just isn't happening too often. We saw it a little bit in April, and we've seen it a little bit recently, but it's just very rare. So in our view, going forward, things can kind of maybe only go like one of two ways instead of three ways, right? When you have spreads this tight, you're either going to kind of stay the same or things are going to widen out, right? And if you stay the same, then you're just going to earn, the yields on the securities that you have in your portfolio. And that actually is potentially not a bad thing, especially if we kind of, have this economy where it's just ho-hum and trickling along. But if something happens where there's cracks in the economy and I don't know, we can never predict this, right? But if something happens where we go into a very deep recession, we believe that there would be opportunity with spread widening in our portfolio and the market that we play in. And you would also have the high credit quality nature of our portfolio, where our strategy and our approach would kind of serve as a ballast in the portfolio. We actually saw this in April, right? April was, the tariff situation, all the volatility in the market. There's a flight to quality. Everyone kind of went to U.S. Treasuries, and we kind of saw our portfolio shine in that environment. Now, it didn't last as long as we thought it would, but those are the types of environments where spreads widen, volatility picks up, and you kind of want to own that high quality bond manager.
Yeah, and I think for us, we kind of talk about your bonds should bond.
I love it.
And a lot of times, there's tactical decisions, we make or firms can make to, try to increase yield or, but sometimes in the effort to chase yield, you can add risk in your portfolio where your bonds act more like a stock. And what I hear you saying is, the place that you play and the reason, you're in portfolios is to be ballast if the market does go down, that you're going to hold up better in an environment like that and provide that diversification investors
Right.
are looking for. So maybe a good segue is, there's obviously the fundamental of what you do, which is fixed income management, and the role that that plays in the portfolio. But let's start to bridge this gap with kind of impact investing, and how you look at the underlying securities that are in the portfolio, and maybe start with the big question of like, can you do both? Can you be a bond manager and invest for impact?
Yeah. So to very quickly answer that question, Chris, yes, the answer is yes. And we've been doing this for 25 years. We've been answering that question, yes, for 25 years. So let me expand on that, and thank you for that question. So community capital management by prospectus, right, with our registered funds and our separate accounts that we have, it's not impact or financial when we're making decisions on the portfolio management side. It's impact and financial. So we are admittedly trying to deliver for our clients market rate fixed income returns over a full business cycle and full market cycle, with impact behind the use of proceeds from those fixed income securities. Let me expand on that a little bit. From the subsectors that we play in or that we invest in mortgage-backed securities. We invest in CMBS, agency CMBS. These are government-backed, highest quality kind of mortgage-backed agency securities. We invest in corporate bonds. We invest in asset-backed securities, and we also invest in taxable munis. And how we do this differently than some other fixed income managers, and this is not to talk down upon any fixed income manager, but we just do things differently at Community Capital, which is where we get flows or kind of securities shown in the market to us from a lot of the issuers in the market. And what we do is we take a look at these securities before we buy, and we actually look deeply into what's called the bond indenture. The bond indenture is a legal document on a bond that basically says, hey, I'm XYZ person, I'm trying to raise money for this project, and I'm going to go out and lend money and So such as how it all kind of comes together. What we do is we feed everything through our internal system that we've had, and we verify the use of proceeds on that bond raise for that project, and make sure that that project is having social and or economic positive impact in the local community, all the way diving down into like the county level. And this all stems back again from the mandate that we have to manage our portfolio under the guise of the Community Reinvestment Act of 1977. So for us, a little bit more detailed example, we invest in agency mortgage-backed securities, which is a massive market. There's a lot of public fixed income managers that capture this market. The way that we do it differently is we might have a mortgage issuer, like for example, a large mortgage issuer on the street. They would show us a bunch of mortgages today. Let's maybe say we see 100 mortgages that we could potentially buy. We do our analysis, and let's say maybe 10 of those 100 mortgage-backed securities are vetted and meet our use of proceeds testing for impact, right? Where there's impact on the social side or impact on the environmental side, meaning it might be like a new building being built that's LEED certified. We would then take those 10 securities and have Fannie, Freddie, and Ginnie Mae package those up into what's called a custom impact pool, and we would then buy that impact pool. So that is how we do things differently at Community Capital Management. Again, it's all the same public, large fixed income market. We're just hand selecting some of these securities, verifying them for social and environmental impact, whereas a lot of other traditional bond managers are kind of just buying, and trading things every other day.
Yeah. So as you're looking at these underlying, use of proceeds, you had mentioned, as an example, like a LEED certified building, and I've seen some research that suggests that office buildings, as an example, that are LEED certified, they tend to also come with like a wellness certification. It's around light and air quality and plants and all of these things. And because they actually become environments that people feel more productive, they feel more happy in.
Yeah.
These offices actually can command higher rents. They tend to have higher occupancy. So are there other, outside of just looking at like, well, this, we want to, focus on economic development, we want to focus on environmental or something like that, but are there kind of these ancillary and underlying quality factors that actually give you, greater confidence in that bond's ability to continue to pay its payment, its coupon, and then return principal?
Yeah. So, for us, when we're looking at the agency CMBS, we're actually not focused too much or investing too much in like office MBS, and that's not because of what's happened with COVID and a lot of vacancies out there. But when we invest in properties like that, we're investing more so on the side of like a multi-family residential property in downtown Cincinnati that was issued through the low income housing tax credit program that has 40 or 50 families or individuals being housed in there that are typically kind of lower moderate income families. And what we do and how we've done this for 25 years is we know the property management teams of that building, right? We know how close is that property to a train line or a bus line so that the residents can actually get to work on time. We know that there's on-site employment assistance if someone's unemployed. First-time home ownership programs. We want to try and get people in their own homes and own a mortgage and build equity. Walk scores, right? Are these close to their building? So all these different types of quantitative and qualitative factors we actually track for impact outcome measurement when we're investing in these properties, and that's what we look for when we're doing our analysis. So this is interesting because we're technically an active bond manager, right? And active management, I'll leave that up for the folks to come to their own conclusion. The active side of what we do is verifying the impact to the social and the local positive impact. when we buy one of our fixed income securities, we're typically kind of holding that security for the most part until it matures, right? And the reason that we do that is because we want to maximize the impact of that security, that social and or environmental impact. If we were just buying a security today for impact and then trading it 5 days later, it kind of defeats the purpose of what we were doing, and we would kind of just become a traditional bond manager. So it's properties like that we're investing in. You know, sometimes we'll invest in a bond that maybe is issued to build a local, family services community center in downtown Chicago or downtown Minneapolis or something like that. So those are the types of bonds that we're investing in, and then ultimately the projects that are being supported behind the bond raise.
Yeah, great, thanks. And I think again, all of those characteristics leads to almost a better quality, like a better quality when you have like wraparound services.
Yeah.
So maybe, our offices are located in Cincinnati, and while we have clients all over the country, and I know you have stories, maybe, share a story or two about what a regional impact bond would look like here.
Yeah, so our registered mutual fund, the Community Impact Bond Fund that we've been running forever for banks and financial advisors that serve clients like yourselves, has been around forever. And so it's a very large mutual fund. We have 2,300 plus secure fixed income securities in the portfolio. And that leads us to basically have, full transparency and impact across the entire country, right? Specifically for the Cincinnati area, I was born in Cincinnati. I'll never get all those Skyline Chili or Grater's cheese crowns. They're the best in the world. But we do have a couple properties in Hamilton County that I thought would be very applicable to a lot of your end clients. The first is kind of piggybacking off of the agency CMBS properties that we like to focus on, is actually Mariana Terrace. This is an agency CMBS property in Hamilton County. About 80% of the residents in this property are lower moderate income families or individuals. And this is actually a property that qualified under the low income housing tax credit allocation program. So it serves a bunch of different residents. It is a high minority, high poverty census tract type of property. And they did do an $18 million renovation in 2023, which helps serve the residents and ultimately kind of bring that property up again to kind of standard. So that's one that's great in serving the community. Another one is actually more so on the serving the kind of senior living community. Affordable housing and senior living communities. This is something that is a huge impact area of focus across the country. No matter your kind of political views, right? Affordable housing is important. So Sanctuary Point Nursing and Rehab Center is also an agency CMBS property that we invested a bond in that supports. This is in Hamilton County, and it has about 113 beds, and about 80% or more of the occupants in this property are all living off of Medicaid. So they're typically lower moderate income families or residents that are receiving the support. They have on-site memory care units, helping the folks that maybe are suffering from dementia or Alzheimer's, dietary nutrition, social workers, all on-site 24 hours. And they did a state-of-the-art kind of rehab for their building a couple of years ago as well. So these are the types of fixed income securities that we're investing in, where we believe that, affordable health and rehabilitation care, sustainable communities, seniors, veterans, and people with disability. These are our impact themes that have to touch on the use of proceeds for our securities before we invest in them. So I just wanted to highlight those two examples. We have so many others that dive into the county level if your clients are curious and want to learn about other examples of all across the country in different cities and states.
Wow, that's great, Patrick. Thank you for sharing. It's really nice to hear how, our investments that we put in place for clients, can have a local impact as well as nationally. So, very great and informative. We really appreciate you being here with us and sharing your knowledge and insights on CCM and the impact bond strategy. And thank you to all of our clients and guests watching today. If you have any questions about today's discussion or would like to discuss how this may fit into your personal planning, please feel free to reach out anytime. Thanks again. Have a great day.
Thanks for having me, guys. It's been great. Take care, everybody.
Thank you. Take
Bye.
care.